expect rate drops in 2026. And as an investor, what does that mean? So if I know rates are going to drop in 2026, one is I know prices are going to start to increase, right? So I want to try to get things under contract before they do.
Interest rates drop, and we talked about prices of commercial real estate going up. The same thing could happen in just residential.
Including the land and the soft costs. Okay, you're still in the window. And 87 for 40,000. I mean, that to me, that sounds like a winner. When you buy low, it's so hard to screw it up. And the key here, people understand, is you don't buy good deals on the market. Okay, you add value to good deals. So because Reed has that property management partner that's successful at doing this, this is the only reason this makes sense, right? You can't hire, like he said, a third-party management company and expect them to do this, right? This has to be internal, close to chest, like your partner, your strategic partner here has to be able to execute. We have a great show today. Today's topic, hands off to hands on, investing across the real estate spectrum. With me today is the Sultan of Smart Money, Dr. Reed Faldet. Welcome, Reed.
Thanks for having me again.
In the news today, we're going to go over in the news, and then we're going to go over weekly updates on some projects, and then we'll go over today's topic, as always. So in the news, I don't know if you guys looked, but treasury rates have been dropping a lot, which is an indication of future interest rates going down, which is good typically. It's good if you're in real estate. It's good if you're in equities. It's pretty much the juice that feeds our entire economy. Have you noticed this too, Reed?
Yes.
We also saw a board member on the Fed resigned, and Trump is put in one of his own board members, and he already has two people in there already. Now he's got three folks that are probably going to support Trump's wishes for lower interest rates in the short term. We know Jerome Powell, the head of the Fed, who Trump appointed a long time ago, but hasn't been lowering rates for him, is out in May. So these are other signs that interest rates are going to drop in 2026. And then I saw a chart yesterday. I don't know, I haven't been able to confirm if it's true or not, but it showed the amount of people who are behind on their mortgages in the US over the last 20 years. And if you remember in like 2008, 2009, there was a massive amount of people, right? Totally shook the economy. The charts show that right now we're actually at a higher level than that. More people are behind on their mortgages than even in the Great Recession. I don't know if it's true yet, but it looked like a very sophisticated chart. So I need to get in there and do some due diligence. But the main point here is the signs are showing that interest rates are going down, because as investors, this shows about health, wealth, family, freedom, right? And wealth is how you buy your time, right? So you can have all the other freedoms in your life. So we focus a lot on investing, how to grow that wealth. Well, politicians typically don't care about investors, right? It's not popular to care about investors. So you're not really going to get policy that benefits investors. You'll get policy that benefits the economy, which benefits the people, right? But if the people can't buy homes because they can't afford it, right? We're at the worst affordability index for buying homes ever. You can't have your American dream. That's a major issue for politicians. It's a major issue for Trump's legacy. Okay. And then now if people are getting behind on their mortgages at the highest rate ever, that caused, the great financial crisis. It was the same thing, right? So that's a major recession here too. So, this type of data on ability of people to buy homes and ability of people to keep their homes, the American dream, this will drive policy. Okay, this will drive interest rates down, which benefits us, on a personal level with our own homes, but also even more as investors. So this is like a major momentum build towards rates dropping in 26. Yeah, what thoughts do you have, reflections, read based off of what I've said? I mean, these are just my personal opinions.
Yeah, no, so it's uh what caused the 2008 financial crisis, and in large part was a massive default on home mortgages. That's not the cause. I mean, that's what happened, which led to this massive supply of homes, right? Which dropped prices down,
Yep,
which created everyone became upside down on their homes,
yep.
construction halted. And so basically, like that created a huge slowdown in the economy, right? No one's building, just go ahead.
Yes, the simplest way to say that, thank you, is defaults on home mortgages cause recession.
Yes.
And yes, if we're the highest people behind on mortgages, right, that makes you think, oh man, what comes next? Defaulting on
Yes.
the mortgages. We know from 2008 to 2009 that can cause a recession. Yep, thank you. Keep going.
Yeah.
Sorry.
Yeah. No, so then if you think about that, right, is if they're witnessing this, you said this is going to be driving policy, right? Government policy because it's going to help the economy, but it's also going to help each constituent who owns a home and again perpetuate that dream of home ownership as an American, right? Like the dream. So if if people are defaulting or late on their mortgage payments, like this is continue to build. The best way to kind of solve that problem or throw a possible solution in there is to lower rates so people can refinance, lower their payments on their mortgage, and then get right side, right? To get back to being current versus
That's the easiest, most straightforward solution, right? Now you can try to raise their incomes, right? And decrease their spending. Well, Trump's already working on the inflation, right? He's already pushing on that piece, and it's so he's doing everything he can there and raising people. He's already doing that stuff, right? So what's the third lever to pull?
interest rates.
Interest
And
rate.
so I saw another chart that was interesting that showed home ownership percentage of the population based on over the decades. So I think it was 1930s to now, like the number of 30-year-olds that own their home, like proportionally, right? It was gosh, it was like 70-80% of 30-year-olds owned a home back in like the
Yep.
30s. And now it's like, I can't remember what it was. This is directionally correct, but if you were like 80% down to 10 or 12%. It's
I
it's
saw the same
just
thing.
fallen. Yeah.
It's tanked, right?
Yes.
So yeah, so the American dream that we're living has pivoted. Maybe the dream has, I don't know. I'm not 20, I'm not 30. I don't know if that's still a 20 or 30-year old's dream, but if you're shackled with student debt, the idea of shackling yourself with home debt on top of that at high interest rates, it's probably not super attractive.
Yeah. Is this a choice? Like, is those numbers reflective of just 30-year-olds choosing not to buy a home and become renters, or are they just priced out of the market, or is it a little bit of both? And it could be that, right? It could be a little
Yeah.
bit of both that are
Could be a
contributing
little
there.
bit of both. That just my sense of things.
Yeah.
Um, So yeah. So anyway, it's 2026. And the other cues is like we talked about before is like Switzerland's interest rates like back at their federal funds rate, I think it was like back near zero, right? Britain, who's been slower to reduce rates, just reduced again.
I saw.
Canada is like a whole 2 percentage points ahead of us on reducing rates. Can't remember where they're at, but they're like in the twos. A lot of the EU's been dropping rates. So it's basically like everybody's been dropping rates the last year almost across the world, and they're way ahead of us. So there's another tether. We don't tend to follow the other countries, but reference points. Other people have been
Yeah.
dropping rates. So
Yep.
we expect rate drops in 2026. And as an investor, what does that mean? So if I know rates are going to drop in 2026, one is I know prices are going to start to increase, right? So I want to try to get things under contract before they do.
Yep.
I'm going to be able to refinance stuff that I haven't been able to refinance, right? I'm going to be able to, my cost of building is going to go down because that interest rate's going to go down. So I can build for a little less expensive. And then when I refi my buildings, I'm going to create a lot more cash flow for myself because I'm refining at a much lower rate, but much better cash out refi in my pocket. but what most people do is they get to this point and they feel like the market's still bad. Job reports wasn't great. The economy's not as strong as we think it is. Like now's not the time to buy. Wrong, right? You want to be just ahead of the lower rates so you get the better prices. Warren Buffett, right? Um, Contrarian investing. So I think the take home for me is I'm going to prepare in everything I look at. You can't predict the market, right? Impossible. But you do want to build strategies based off of where you think things are going, right? And I'm going to be using those strategies for 2026 in my brain. How about you, Reed? What are you thinking?
Yeah, as we've kind of talked about on the early shows too, is like even though it's a hard time to buy because interest rates are high, carrying costs are high, it's also a great time to buy because if you can make a deal work right now, it's really going to work after those interest rates come down. So it's really understanding the opportunity is right now because like you said, if interest rates go down on commercial real estate, cap rates will tend to go down, right? Because there's a spread there.
And
So
prices go up.
and
Yeah,
prices
values
go
go
up.
up.
Yeah. So interest rates down, cap rates down, prices go up. So that means that when that happens, when prices go up because everything becomes cheaper, like you want to be able to maximize that opportunity, that increase in value. And if you already have something under ownership, you can. But if you're trying to get into the market at that same time where all this capital is becoming available, everything's going to flood in at the same time. And then therefore the demand exceeds the supply, prices are going to go up. So yeah.
100%. I think the other piece here, this is great. We're doing a discussion. It's really triggering for me. So, if I buy something with owner financing, right, at let's say like a 6% interest rate, I'm not paying loan fees. I'm not doing all those things that make a loan hard to get out of, right? So buy owner financing now. Next year, get like a 3-year, 5-year owner financing deal. But in a year, if rates really drop, get a takeout loan, right? Get a bank loan at that point because the numbers are going to work really well. So I think owner financing is a play right now. A lot of guys have had their properties on the market for a year or two, right? And those guys are ready to be done, right? Mentally checked out. So go buy the properties that have been on the market for a year or two with owner financing, and then get
Yep.
it for 3 to 5 years. So you're not stuck, but then
Take the
refi.
problem off their hands. Take the
Yeah,
problem off their hands.
you'll look like a freaking genius. The other thing is, I've been doing my annual investor calls, right? We do questions, we do reflections, and then we talk about the next 12 to 24 months. And when we're talking about our current deals, kind of how they're doing, we buy low, right? Like you buy at low prices and and then we buy in good markets, right? And then the most important thing are the operators, right? You partner with some great people, especially your property managers, you can really add value. Similar. But like the question is like, when do we exit? Okay. And most of these folks, as soon as you get like a 2x return for your investors, you're looking to exit that property. And what creates a 2x return, like what's the real trigger here, is interest rates go down, cap rates go down, values go up. All of a sudden, you're going to see these multifamily properties that have been doing fine, right? They're still cash flowing, they're doing fine. Like that set, not the ones that have been struggling, but the ones that have been doing fine. Interest rates drop, you give cap rates another 6 months to drop too, and now you're churning these assets. So, yeah, you may see a lot of these syndications that you're in, churn.
Yes, that's great, and that makes perfect sense. I just something popped in my head as you were talking there. So,
Mhm.
if interest rates come down, home ownership becomes more accessible. What will that do to rent demand for market rate rent markets? Will it affect it negatively?
No, it's not that black and white. So, yeah, what you're referring to is there's a gap between if you went and bought like a starter house, right? Let's say your mortgage is 3,000 a month. Okay. You go rent, it's 2,000 a month. Okay, there's that gap. That's $1,000 in this case. a 50% like difference from 2,000 to 3,000, 50% difference. Um, like you have to
Yeah.
add 1,000 to 2,000. That's why I say
The,
50%.
the price to rent ratio, right?
Price to
That's what
rent ratio. So usually 30% is the number, right? So if it's 2,600 to get a mortgage, you're kind of at that cusp where above 2,600 people are going to tend to rent if the mortgage is above 2,600 and rent is 2,000. If it's above 2,600 mortgage, they're going to tend to rent. If it's below 2,600 for a mortgage, they're going to tend to buy. Okay. So you think in your brain, it's like, oh, if interest rates go down, makes it more affordable to buy, you're going to have less renters. True, but too many factors here, multifactorial. So one, yeah, the people who are kind of saving up to buy a house can all of a sudden buy a house. They'll move out and buy a house. True.
Yep.
But then you have a bunch of like 20-year-olds, and this is anecdotal for me too. This isn't just like theory. Like I see this every day. My neighbor, two boys living with them, right? They're one of their sons and their son's friend, right? While they're in school, they're not living on their own, right? These are 25-year-old guys, right? Living with their parents. Like when I was 25, I did not want to be living with my parents, right? I want to come home on the weekends, have a dinner. I did not want to live with my parents, right? So these guys are making a choice based off of affordability in general, right? That they have to live at home. Okay. But let's say interest rates go down, it juices the economy in so many ways, right? Maybe their student loans cost them less now. Maybe they can get a better job now because the cost of capital for that company is lower, so it increases like their free cash flow, so they can pay them more. And now these guys who were living there, now they can go rent, right? So I agree with what you're saying. But what I've seen when I've looked at the charts and numbers is it's not that way, right? Like we have good occupancy rates right now because construction is slowed. But if 5 million people are looking for a home, like you don't see the apartments like overflowing right now, right? You see people living at home, or you see people living with two roommates instead of having their own place.
So yes. So I guess if interest rates drop and we talked about prices of commercial real estate going up, the same thing could happen in just residential as well, because single family homes, whatever, because now you're flooding the market with potential demand of people to buy homes. So there could be a price increase in certain markets as well, where that price to rent ratio is closer and there's not as much of a gap.
The days on market, right? You have days on market is the residential metric that you look at, right? And inventory, right? Those two.
Yep. Yep.
So if you have massive inventory in an area, lower interest rates will increase demand, but it'll just eat up that inventory. It won't necessarily really raise prices, right? But I looked at like another chart this week. It was like Riverside, California, like average day to close, like 11 days on market, right? Like there's not a lot of inventory in Riverside, California, right? So yes, Riverside, California prices will continue to increase. Absolutely.
Okay.
Um, those are good intuitions. So
All right.
okay.
So updates next.
Updates.
Project.
Why don't you
What you got?
start, sir?
You want me to go first? Okay,
Yeah.
let's see what's interesting for me. So we just got so this is kind of a fun one. It's a 54 unit that we got under contract. Uh Price per door is under 40,000.
Do they have doors?
They have
Are these
doors.
units with actual doors?
So this is but the rent right now on the average rent for those units is like 750 or something like that.
That's
So
great, man.
yeah,
This is
yeah.
is this Kansas City?
Yep, yep. So it'll be the same partners I always have that we just kind of keep expanding in that market. It's a C-class property, C-class area, obviously, when you have those type of prices. But it's like a 1987 build. So it's not that, not that old. I mean, old enough, but it's not bad. And so it'll need a little bit of sprucing up, but
Yeah. I mean, my hunch just hearing that is you're going to take it from C minus to C plus with your team,
mhm.
right? And you're going to go from 750 to I don't know that market, right?
It's
Whatever the
we're
next
we're we're thinking we're thinking 850, but a lot of the things around it are 900, but we're just undercutting it a little bit, undercutting the market for that C class property. So
You
yeah,
just
we'll
can't.
think about it.
Yeah, and three valuation options, right? I mean, there's income approach, right? So going from 750 to 850, you got to put some work into it. There's um sale comp. Yeah, who cares about that one? This is unique property. But the big one is replacement cost, right? Like what's it cost to build a unit in Kansas City? 200K a door?
Close. It's close. I mean, all and no one's building really class B, class C, right? Everyone really builds class A. So it's yeah,
It's at
200K.
least, right? Including the land and the soft costs and
Yep.
hard costs. So,
Yep.
so it's like if you're buying it, you say 97?
87, 1987 build.
87. Okay, you're still in the window. And 87 for 40,000. I mean, that to me, I- that sounds like a winner. When you buy
Yeah.
low, it's so hard to screw it up. And
That's
you've got a
it,
property
right? That's what
management
we're
company.
so in my partner owns the property management company, right?
Yeah.
That runs all these deals. So
Yeah.
so that's where the opportunity lies here because if I would not use a third party property manager on a class C asset like this, it's just a little bit more management intensive. And so that's part of the reason why we got this at such a good deal. This initially went on market 10 months ago at 3.5 million. And then when we dug into it, we're like, no, it's not worth this, right? And it was mismanaged. Even if occupancy was great, just like delinquency was high, they couldn't retain tenants. Like, they went through three different property management companies. And every time you do that, it creates this kind of stressful situation for tenants. You lose tenants, you have turnover, you got a lot of unit turns. And so just operationally mismanaged. And so that is the opportunity and why it sat on the market for 10 months and why we could come in. They come back to us and they're like, please take this off our hands, right? And so you swoop in, out of state owner, you take it off their hands, and then you turn things around. And we think it's going to be worth back to that 3.5 million within a year.
Yeah,
We'll
I
wait.
think so too. I think so too. And then you get a refi at a low rate. If low rates go down.
Yeah.
So I mean, 3.5 is a little low for agency debt, right? So what's your debt? They usually like 7 million and up. Which well, 5 million
Mm,
and up for Freddie Fannie, but they'll do lower. Okay, so you're gonna go Freddie Fannie.
yep. We did Freddie on one similar size, and that's what we're quoting for the other one. But some of the banks are pretty competitive right now. The bank that's quoting us for this property is a 6.2% interest rate with interest only for 1 year. And then I think 25-year AM. So,
What's your prepay years
oh, we
penalty?
negotiate, you always negotiate no prepayment penalties.
Yeah, you're good.
So we don't have an issue with refinance.
Yeah, your biggest risks, right, are structural, right? Foundation, sewer,
Roof,
um,
HVAC.
plumbing. Yeah, I mean those are your biggest risks, right? Because like everything else is just like this is good.
Yeah. So property inspection is going to be big. Our partner, Brett, who runs the property management company, will walk all the units like he always does. They'll also do a formal property inspection. He always does a great job with CapEx, and they've been spot on every property we've had so far. Of course, there's always some random thing that comes up, but nothing earth shattering. So as
I
long as
love
that
it,
comes
man.
back, yeah, we'll move forward and take her down and hopefully have another true burr, right? 100% pull out in a
Yeah,
year.
this is sounds like it. And the key here, people understand, is you don't buy good deals on the market. Okay, you add value to good deals. So because Reed has that property management partner that's successful at doing this is the only reason this makes sense, right? You can't hire, like he said, a third party management company and expect them to do this, right? This has to be internal, close to chest, like your partner, your strategic partner here has to be able to execute. So that's the only reason this works. Don't go like, hey, I found a $40,000 door place in my city too. I should buy this, right? You're going to probably be dealing with like gang members and like no property manager wants to take it, especially at that small a size. Like it'll just be a freaking nightmare, like it is for those current owners. So good
Solving the
job.
problem.
Okay, any
Yes.
more project updates there, sir?
Oh, nothing too exciting. I mean, just trying to, and we can talk about this offline a little bit, but working on trying to bring a JV partner in for some of the development projects that have been taken to like plans and permit to then, go vertical, secure a bigger construction note. So just talking to different possible co-development partners on those projects.
Yeah, let's
Um,
chat.
yeah, so we talked about that a little bit. So that's a new world for me, learning a little bit on that side. But that's a world you play in all the time. So
This is what I enjoy. Really. Okay, so updates. Let's see here. The biggest update, we'll focus on this one update. So I have a property that I've mentioned here occasionally that is right on the edge of a gentrified area. So it's not gentrified, so I can't expect to get those high rents, right? I got to be realistic. And what's nice about this area is the city spent $30 million recently right around it. They redid a park, brand new aquatic facility, brand new library, brand new early learning childhood center. So the state's been giving away a lot of money for early learning centers. So that's like before school starts, right? You want to free parents up to work, you started schools. But what about when parents are young, kids are young, parents still need to work. So what do? You create early learning centers. So Washington State's just putting a ton of money into that. So we have a
that's awesome.
beautiful brand new early learning center like feet away. And then also another a nonprofit developed, they had some apartments and they just developed, I don't know, like another 80 there. They got a bunch of that, they had a capital stack, probably like 7 different funders. Okay.
Oh,
So affordable, right? Pretty affordable here. So, and my property is right in the middle of all this.
hmm.
Um, so I'm looking at my property. It's got some challenges. It's rocky, right? What does rock mean? It means the civil engineers gotta be smart. And it's the road isn't paved, and so the city typically doesn't have money for extra stuff. They're typically going to want you to pave the road, those types of things. But I'm right in the center of these two pieces, the park, and there's also a bike trail. And cities love bike trails, right? Like you think bike trail, oh, it's nobody else. It's like a nice little bike trail. A bike trail to a city is like massive. There's biking initiatives. People are on biking committees. Like
Yep.
this is like a big thing for city council members. So we're in the center of all this. And so whenever I, as a developer, your job number one is highest and best solution, right? What is the solution? What does this property need? Okay, that's your number one job. And then number two job is execution, which is just solving problems, right? Okay, relationships and communication, all that stuff. So number one problem, highest and best use. So when I'm looking at this guy, I'm thinking what's best here. So what best here to me is a mix of market, okay, because I can get pretty good rents here, and some affordability. Okay. And when you think market, think an average median income. Okay. So for like a certain area, what's the average income in that area?
Mhm.
And if the average median income for like my town, let's say is $100,000 per household, okay, you're going to assign areas and rents as a percentage of that. So most of my rents are built on around 100 to 120% of average income. That's what I typically build. One tier above market, a little nicer. Okay.
Okay.
I'll still build a little nicer because it's just who I am. But on this one, I'm going to be a little more realistic with my finishes, right? I got to meet people where they're at. This is going to be probably 100% of market income to about 80% in that range. Okay. So households that are 80 to 100K. And then we're going to sprinkle in a little diversity to serve the public. Okay. That's going to be some, we might have 4 veterans with disabilities on the main floor in their own apartments. Okay. And probably going to build some townhomes. Okay. And these townhomes are going to be people that are in that 80 to 100% range as well, right? People who are making $100,000 a year right now are going to have trouble buying a home, right? So I got to build townhomes, which are going to be much more affordable. And I've got to create a little assistance for them. There's some like mortgage assistance programs, down payment assistance programs in the state, actually a ton of them. Okay, so I'm really trying to formulate who my mix is. And anytime you do a development, even if there's a little bit of like lower income in there, you can't have it all lower income because then it turns into the projects. You got to
Yep.
have a diverse socioeconomic um, map for your project. Okay. So where this one's coming in as is 80% of our tenants are going to be, like I said, probably towards 100%, and then a little of the 80%, and then a little of the 60%.
Mm.
And the city likes that, nonprofits
Yeah.
like that, everybody likes that because you're taking people who are at the 60% level and you're surrounding them with 100% level people, help bring them up and foster. And then also home ownership. You create townhomes instead of rentals, you create a pride in ownership, and it also improves the property. But what were you gonna say?
I think of it, it's kind of like sometimes GP dental offices where you have your high-end clients, but you have serve the middle the most. And then you might take some Medicaid, right? Just to kind of balance it all out, serve, but then you have the full spectrum and it helps the community out pretty well. So I kind of thought about that as a parallel when you were speaking.
Yeah. So absolutely. So, that was my vision here for like highest and best use for this property. Okay. But then you got to tie it to money. If it's hard to build right now, it's hard to make things pencil, right? My projects are typically in nicer areas because I can get that to pencil because my building costs don't change that much. Yeah, I can use some nicer finishes. They'll go up a little bit, a little less nice finishes. But overall, the cost of lumber is the cost of lumber, right? The cost of fiber cement siding is the cost of fiber cement siding. The cost of flooring, the cost of drywall is the cost of drywall. Like 80% of your costs don't really change. Okay. So
You're
you
building
can't,
suspense here. You're building
what?
suspense. You're building up suspense to something.
Good, good. I'm beginning to be you're a better storyteller. So, when I see all this, right, and I'm like, hey man, this is a freaking cool spot. Like this would be so cool for the community to be able to put families here, right? A couple of veterans with disabilities, a couple of families that maybe have been displaced from their home, like just a cool spot. You got that huge park, you've got this early learning childhood center. You got a school that's like 5 minute walk away, elementary school. It's like put the people where the amenities already are. Don't
Mhm.
put people in out in the country where they got to drive 30 minutes in, right? Put the people right where the city's already spent 30 million. Okay. But now so my only issue here is a funding gap. So what do you do, right? And being a dentist in the past, like why not us? Right? Let's focus on problem solving. Let's see what's out there. So I started digging around for follow the money. Where are city, state, and federal folks giving money right now? Okay. There are certain programs, LIHTC. Okay. You can look it up. LIHTC. Big place people are getting money.
We have a deal under contract. It's a LIHTC deal, so that's
Okay.
interesting. Funny
This is
that.
low tech. This is a different states are different though. It has to be awarded by the state in Washington, and it's super competitive now. Even though the federal government's just made it even better with the big beautiful bill, it's super competitive. So when you look at the award winners, it's all like Catholic Charities, Veterans of America, and you're like, there's no way I'm gonna beat these people, right? But with the bigger dollar amounts, it may open up a little. So I'm gonna keep an eye on it, right? So I look at it, I talk to people, it's just not viable right now. So I say, okay, I'm not going to apply for that one, right? New market tax credit. You need to have, typically you need to have retail with it. That's another very big one. New market tax credits, free money, okay, from the federal government. Historic tax credits. This is land. It doesn't have a historical building. Can't get the historic tax credits, right? So I'm like, where's the money? Okay. I just keep talking to people at the city level, at the state level. Okay. For those veterans with disabilities, there's vouchers. Okay. So if they're going to pay $800 a month, the voucher will pay the rest. Okay. Pay another 800 bucks for us. Okay. So I'm like, oh, now we can afford to have veterans with disabilities in our development, right? I can serve the people. Another one is like people who have been displaced from the home, families, same thing. There's vouchers for that. Okay. So I can supplement like the 60% level, those 8 apartments out of the 42, they're going to be like those populations that need the help, right? Like do good, doing good. Like, but you got to make the numbers work, got to make it sustainable. Just because it looks good on paper doesn't mean it works, right? And then I start looking around. We talked about federal money. We talked about state money, city money. I started looking at like what has the city been doing? Because the city is like affordability, affordability. Like Spokane's one of the leading like pushing for affordable housing in the state. Every time the state comes up with something, Spokane's adopting it quick. They have different programs in place. We've talked about the the multifamily tax exemption right, where we don't pay taxes on the building for 12 years. Okay, check, got that one. There's another one called parking for people, where if we take a parking lot, this one is not, unfortunately, and you convert that parking lot into housing, you don't have to pay sales tax on your construction. So that saves you like 9% on your construction cost. Massive benefit.
Yep.
Okay. But what the city has been doing is from this local municipality taxes, about 5 years ago, they started sectioning off a piece of county and city taxes into funds to fund affordable housing. Both, and there's three main ones. There's one for like affordable apartments, there's one for affordable homes, and there's one for like really affordable apartments. The really affordable apartments, that is not an area I play in. C minus, that I don't have a property manager that plays in there, a good relationship, so I'm not going to go there, right? So we're going for affordable apartments, usually 80 to 100% with maybe a little bit of 60, and then 50% of average income again, right? We don't play in the 30 to 50% range. And then there's another one for affordable homes in the 80 to 100% range. Okay. So I see this, the money's there, and you just apply for it, right? It just takes time, right? And expertise. And you're going after their capital, right? The city's capital, because you're aligning with their goals.
Yep.
So I applied, right? Met with the people who are kind of presenting these awards, that organize these awards. I met with them, gathered feedback, presented ideas, gathered feedback, presented ideas, met with the local neighborhood council. I met with 2 city council members at the site. I teamed up with one of the large nonprofits in the area, right, that helps with displaced families. I talked to the state about their disabilities with veterans program, like just gathering stakeholders, right, understanding what the problems are, and then seek to understand before being understood. I present our project, and I was going to do apartments at first, but now that I see that there's 2 pools of money, and I love that the townhome money, home ownership increases the care with which people care for their properties. I'm like, hey, this is very synergistic. So I present this solution. I named it the threshold because it's right at the threshold of these amenities, and it's the threshold of these 2 neighborhoods. It's the link, and there's no other link for a half mile in either direction. So it is like the link. So I named it the threshold. I made a little presentation. I presented it. I did all the financials. Got an email this week while our family was coming back from the cruise, and it was it has to go through a couple committees, and then it gets presented to the city council, and the city council reviews what the committees have done. Like, it's the job of the committees to do all this, and the city council says, yes, this is what we're going to do. Sounds good. Got the award letter, the recommendations to the city council. We received the largest award, as far as I've ever seen, that the city's ever awarded. This is my first affordable project, right? This is not like the 5th time they've seen me, right? The largest award ever. So on this project, for the apartments, 1.6 million and 1 million for the townhome. So $2.6 million from the city.
And is this is straight grant money that doesn't have to be paid back, or
Good
how does that
question.
work?
Good question. I think that I'll have to look on these 2, but with the city, what you got to understand with the cities and the municipalities is, even if it's a loan, it's they just can't write off things off their books. So I believe our current terms are something like loan payments start at 1% in 10 years.
It's basically free money. It's free money.
They're very flexible. You just need to be hitting their guidelines, right? Having the right population, creating good housing, not a dump hole, right? Like a terrible place to live. You follow their guidelines. They're very flexible. They want to be your strategic partner. They just need to make sure you can execute. Good.
So yeah, so what would you think? What would you put as a amount of time that you spent on doing all of this to get to that $2.6 million award?
A lot. A lot, because it's a passion project for me, right? I want to do some of this affordable housing, maybe one out of every four of my projects, right? I want to have like community impact for more stakeholders. And it bothers me when I see a really cool piece of land that needs to be developed, but it's just in a lower socioeconomic area. I'm like, gosh, we could do something so cool here. It bothers me that we can't because the rents aren't as high there, right? So this is a passion project for me. So I put a ton of time in, Reed. And I will tell you that once you win that first award, the other agencies, the other government agencies actually like you more. They're not like, oh, you got money, we're not going to talk to you. They're like, oh, these people gave you money? Oh, like this must be a good project, right?
It's a quick way to vet, right? If you already know they're awarded, someone else went through the vetting process, they're already that much warmer to you, right? Essentially.
Yes. And my
Yeah.
application's already 90% done for these other ones because we already have all the data. Now we just got to tailor it to these next. So there's three more awards we're going to go after at the state level.
Yeah.
After August 18th. So in 10 days, the city council is going to review it. Usually that's a non-problem. And like I said, I've already had city council members come to the project. And I've built it for all the stakeholders, right? For everyone to benefit. Um,
So even if it took you a year of full-time work, which it probably did not, right? I mean, it was you were every now and then you had a push, you had a call, you had a talk, right? But you're also building relationships and getting other type of value other than just pushing this thing through, right? Because you're making all the connections with the city people, the state people, going back to them in the future when your project needs to get rolling. They'll just want to grease the wheels on it because they themselves are funding it, right? So the city's, even though it's a different department, they're going to help with this.
they're going to help with it. They're now a stakeholder, right? Because the more
Yes.
money we get, the cooler we can make the buildings, right? The
Yep.
cooler we can make the property for the community.
Yep.
So I think your point here is kind of getting to our today's topic, right? Is, just like when I started a dental practice from scratch, right? Blind belief. Like, I'm going to start this thing from scratch, even though I've never owned a dental practice before, and I'm going to make it successful, right? I'm just going to jump in the pool and believe in myself and do it. With this type of thing, yes, if I did not get any money, right, I had to know that this is something I want to keep doing every year,
Good point.
right?
Yep.
This is
Yep.
going to be a part of my life and something that I believe in and I want to get good at. So even if I spent 200 hours on this and that, if I value my time at $1,000 an hour, right? Like $200,000 out the door. Like for me, it was something I wanted to do, so I was okay learning.
Yes.
Um, yeah. So you have to be okay with zero return on your invested time. So
Knowing that you just established a foundation for future learning and possible value creation. I mean, that's it.
that's but it's two different tracks. So if I'm just thinking about the deal, if I didn't get the money, it's failure, right? But if I'm thinking about this is what I want to do with my life, I want to do one out of
Yes.
four of my projects is impact investing for the community, then even if I fail, I still win. Two different
Yep.
tracks and two different mindsets in life.
Yep. No, I'm with you 100%. There's so many things like that though in life that you'll be like, I know eventually I'll break through here and I'll figure it
Yes.
out. And I know this is the right path. So I'll just keep hammering on. The problem is too many people hammer, stop, turn, hammer, stop, right? Before they actually break through and make meaningful progress in that specific track.
The obstacle is the way, right? But the key is you got to know yourself, right? If you don't know yourself and you try something and you think, then you're not going to stay committed to it. If you know who you are, right? I know that community impact matters to me. I know that I love development. I know that I'm not moving from Spokane, right? So I knew me, so I'm willing to push through all the pain and the uncertainty
Yeah.
and the
Well,
money
that's
that I spent buying the land, paying taxes on the land, paying the civil engineers, the architects, like all that.
there's a certain I feel like there is a just a pattern there, and this is a perfect segue because I know what we're getting into. But there is this pattern when you talk to people that have had success, and it's that I knew I wanted to do this thing. I didn't necessarily know how to do it, but I was very passionate and motivated to learn it and be successful at it. And so I'm gonna, like you said, blind faith. I'm gonna jump in. I'm gonna put all my effort into this thing, and at the end of it, I'm gonna learn something, right? Or I'm gonna be successful. Either way, I win. I either learn something that allow me to have a greater chance of success the next time I do it, or I'll be successful. And you just keep pushing on from there.
This is every Silicon Valley founder story I've ever heard, right? Like we just niche down and win for it. No
Mm.
guarantee of success, right? And just put in the hours. I think you nailed it. I think that is the story. That is the success formula for entrepreneurial individuals.
Yes. Yep. I think Elon Musk said he put his success rate of Tesla at one point of like less than 10%. Like when he was building, he's like, we're gonna go bankrupt. He's like, I thought we were gonna less than 10% chance we'd be successful. But he just kept on and there he is, richest man in the world. So okay. So are we ready to pivot
Let's do it.
today?
But that was great content for folks. So I feel like our focus on those projects and those lessons, I mean, I think those are so important. So let's hit today's topic. Today's topic, hands off to hands on, investing across the real estate spectrum. Reed, every deal requires three things. What are those three things?
You have three things now? Oh, whoa, whoa, whoa. I know where we're going with this. Yes. So basically, time, capital, and expertise. Those are the three things.
Yep.
So, yep, it doesn't mean that any one individual has to bring all three things, but all three things are necessary to have a successful deal from start to finish.
Absolutely. So if you're wanting to get into real estate or you're in real estate and you're not sure if you want to continue, look at those three resources, right? And if you're not, willing to put in the time outside of dentistry, outside of your career, outside of your family, or, you're not having the capital churning off from your dental practice, if you don't have that capital, focus on your dental practice, grow that capital and expertise. You have to be able to face obstacles, grow, learn from them, and like enjoy it. If you're not looking to grow expertise in an area, then you need to partner with somebody who does have that expertise. Time, capital, expertise.
So to kind of set the stage of why we decided to talk about this is Josh and I often talk to dentists, right, who are like, hey, I want to get involved with real estate. I want to get started investing in real estate. And so their always question is like, where should I start, right? And so it often starts for us, like I won't speak for Josh, but for me, oftentimes it's like, okay, well, let's get realistic on your expectations on what you want to spend in terms of time, right? One of these three things, like, can you allocate time to this and how much? Do you have expertise within this certain asset class or in real estate in general? Um, and do you have the capital, right? So, like, oftentimes as dentist, if you're working a full-time schedule, 4 days a week, 4 or 5 days a week, just producing dentistry, you probably don't have the time, right, to actively pursue real estate. And so we're going to talk about that kind of spectrum of being passive in real estate, completely passive, hands off, versus like leading the show, kind of like what Josh was talking about with his deal.
And and like just from a personal note, like story wise, right? Like I decided on dentistry that, I'm very grateful for my time in dentistry and all the friends I've made and the patients and the team. But like I was no longer willing to put in the time. I was not seeing the capital return that I like. And I just lost passion to continue to develop expertise and stay sharp in that area. So I just reflected and I was like, where do I really want to spend my time? Right. It was real estate development. That was my passion. I was making more money doing that. Right. And then I said, okay, well, if this is what I want to do, I need to commit to gaining the expertise. Right. I need to read books. I need to do smaller deals first and then grow from there. Same with equipment, right? So I started buying heavy equipment because the tax benefits. So I get the depreciation against my active income when I don't have depreciation from my real estate in a certain year. Well, renting equipment to folks is a lot of work. Making sure the equipment's rented, making sure it's getting maintenance, insurance, transportation. Um, and those are high value assets, right? You can't have them sitting around. They just depreciate, and not in a good way, depreciate on value, not in a book value. And so, I found a partner, a very large, sophisticated partner that is growing and doing well. And I said to myself, wow, I can still get these tax benefits. I can still get good returns. And I don't have to be the one who who's doing all of it, right? I can really maintenance my time to 100 hours a year and be successful. So, yeah, find what you're passionate about, what you are, what you do want to commit your time to, what you do want to find an expertise in, and make sure you got enough capital to make it worth it, right? The young dentist who's making 150, 200, 250 and wants to start investing, it's like, hey, use that money on CE, right? Get your income up to 3, 4, 500K, then start focusing on real estate. Before that, it's a distraction in my mind.
Yeah, we've talked about that quite a bit too. It's just it's not your best use of time to then spread out your bandwidth pursuing something else, right? That isn't going to yield what you need it to yield. Real estate is not a heavy income play. It just isn't. Not for a while. It takes time. So your best strategy is double down on maximizing your income first, and then basically taking the income you have beyond your expenses and investing it until you gain expertise in real estate or whatever asset class you choose, to the point at which you can spend more time on it because your income's already been high enough. You have enough money invested. Maybe it makes sense to double down on that track. But in the beginning, you have to solve that income problem first.
100%. Like my buddies, they get to like 500 grand a year, 3 million a year in dental income, and they know how to run their practice now, right? They're sharpening the sword. They're making their practice a little better every year, but they've kind of gotten to where they want to be on the dental side. But they look at their wealth now. So they look at their income, it's high. They look at their taxes, it's high. And I'm sure it's the same for your clients. And then they're like, but my net worth isn't that high, right? Because they're paying so much in tax. They're doing stock investing where it's liquid and it has decent returns, but it doesn't have great returns, right? So they're like, hey, I finally reached this pinnacle of this mountain, right? I've spent the last 10 years getting in my practice to it's very profitable. And it's still a pain, but it's not a big pain. I know what it is, right? I know what my problems are going to be. How do I get to a point where I'm free to exit when I want, right? I don't want to have to work the next 20 years doing this, paying all these taxes. I want to build net worth so I can exit when I'm ready, right? That's the pivot point in people's brain. I've noticed when
Freedom.
freedom,
Freedom.
they're ready to maybe not pull the trigger on selling the practice, right? But they're ready to say, I want to be free when I'm free, right? So that's real estate. The equipment's a little different because equipment allows you to delete your income tax, right? So instead of paying 100 grand to the IRS, you pay 50K, invest in some equipment. The other 50K now you have to invest and start building wealth. So equipment you can do earlier on, but the real estate, the heavy real estate investing, you just want to get over that hump.
And don't get too deep into the equipment side because I think we're going to go deep next week on that. So keep a little bit in the tank that we can hit on next week. Okay, so let's talk about this real estate again, being passive versus being fully active in real estate, and where you might fall on the spectrum and why you might different ways to think about it. If you are going to decide to be fully active in real estate, there's an amount of commitment that once the train leaves the station, you're on it. And so there is no, I'm going to stop allocating time towards this, right? You're like, I'm stuck. You're going to keep working it until that project is completed. Similar to like if you buy a dental practice, right? You are committed to running that dental practice until you sell it, or until you build a management team, right? That can run more of it for you, but ultimately you are responsible for it. So that is like the extreme end of ownership in real estate is if you're actively involved, that's the pressure you have to feel. It's the business of real estate. Now, if you're on the far passive side, where maybe you're just being you're being a capital investor, a limited partner, you're investing in it, right? This you don't have that same pressure because you don't have the debt. You're not running the day to day. Like, yes, you're having some faith in whoever the operator is to produce the income that they said they're going to produce for you, which there's stress in that, but it's not going to start pulling your time in, right? You are not necessarily at risk for millions of dollars of debt that that is going to be coming due if you do not fulfill your business plan and execute, right? So that pressure doesn't quite exist the same as when you're fully active. I mean, imagine the development deal that Josh is trying to do here. There's pressure there, like, and it forces you to sharpen, right? Like to get better and better because you have no choice. You are committed. You have to see it through. So just keep that in mind when you're kind of deciding how involved you want to be, because sometimes we romanticize real estate and it is great, right? We love it. We have passion for it, but there is stress. There's ups and downs, just like people romanticize owning your practice. Like there's no doubt that there's stressful elements of that. And so you just have to be honest with yourself on how committed you are.
I reflect on this, right? Like when I wake up in the morning, I always feel like a 10% panic monster.
Yeah.
That's the word I use, right? Like, I sold my dental practices mostly, sold the one. I still have shares in the other ones, but I still have one. We're like managing partner. But the whole like retirement mindsets, that's not a reality. Like anytime you're involved in something, a business, even if it's running well, there's still that like 10% that it's like you just fear, hustle, like
Yep.
yeah, it's always there. But I think the litmus test for me personally was I didn't like the dental problems anymore. The staff turnover, people not showing up for work, those weren't problems I wanted to solve anymore. But the real estate problems, lack of, whatever, there's rock on the property, or where are we going to put this sewer, or whatever the problem pops up, it's fun to solve those, right? Even if they're stressful a little bit, I like solving those problems. So I think that's the litmus test for you too personally when you're looking at like where you want to allocate your time. Ask yourself, there's always going to be pain. There's always
Mhm.
going to be obstacles. That's part of life. But
Choose. Choose
where's
your
your
pain.
heart? What
Yep.
what problems and pain are you leaning towards? Right? What
Mhm.
does your right? Like I just lean towards financial problems. I lean towards real estate problems. Those aren't problems I shy away from, right? But when I had the dental problems, I wanted to go crawl under a rock and hide. Right? I was like, I do not want to solve this today. And then I just like, okay, I can do this. I've done this 100 times. Let's do this, right? But I think that's the personal journey you need to go for yourself when you're trying to decide where to allocate your time. Um,
So yeah, I think that's great, and I think we've had that conversation a couple of times too. I was kind of similar. I have not exited dentistry. I still practice dentistry, but on a part-time basis. I basically built our practices up to a point where they were less management intensive, so that I could really devote my time to real estate, which is where I want to spend most of my time. So I still have one foot in the practice, even more so than Josh does. But it's important again to know yourself and know what you want to spend your time on. I have great balance right now, but I'm spending a little more time than I want to on work in general as real estate right now. The 70, 80 hour work week sometimes can be a little much, but there's those stages, and I'm in that stage, and then it'll shrink back, and I'll expand again, and I'll shrink back. But when there's momentum, I can't help myself. I got to keep pushing.
Reed, when you're good at something, right? Like you tackle a problem and you're good at it. Society, friends, network reflect back, and what you're doing starts to expand because you're good at it. Okay. So you got good at dentistry, that expanded to two practices, and then you kind of cut it. You said, this is where I'm going to stop. You're doing good at real estate. And so it's going to continue to be expansive for you. You're going to have more deals fall in your lap. You're going to have more strategic partners. You're going to have more investors. And so it's going to continue to expand. So you're going to need to start saying no to things, right? And
Yep.
it's just like, as you said, it's expand and contract, but the expand and contract, I want to be clear, it's not going to go away on its own. At some point, Reed's going to need to say no to something, and that's when it contracts. It's an active decision. It won't really shrink up for him long term, until he says no to something. Just my opinion.
Yeah, no,
External.
It's in the early stages you say yes to everything, and then later on
Mhm.
you're like, I have to be very conscientious of my time. And we'll get into that, the time element of deciding, right, how active or passive you want to be as well. I think we should probably dig into that next a little bit because that's where I spend a lot of my time thinking about how I value my time, right? And if I'm using it on the highest and best use thing, to use your development kind of analogy, right? Is you always want to be highest best use. And so I consider myself, I think through that lens all the time. Is this my highest and best use of time? And how can I keep getting more and more leverage so that I can get more done? And so that is building the business around real estate, just like you would build the business of your dental office, is understanding like, I am not going to call the insurance company, right? I am not going to work overdue recare, whatever it is. I'm not going to pack that cord. So I'm like that in real estate. I want to build the scalable system within real estate. And so that's where I'm kind of, there's a little more push right now because I see systems that I need to build.
Episode is really gold for anybody going through their own real estate journey. I think the things you're saying here, Reed, are just exactly what people need to hear when they're embarking upon that journey. This is great content. Okay. Do you want to dive
Should we?
into the five areas of real estate,
Yeah.
the real estate
Yeah.
life cycle
So
almost?
yeah. So and Josh and I quick touched on these and we went back and forth, debated a little bit of nuance, but I'll just list mine and Josh can correct. I think I edited it appropriately. So every real estate deal needs, we talked about time, capital, and expertise, right? That's kind of what it needs to get done. But then there's categories of tasks that need to be completed in order for it to get done as well. So, for example, the categories of any real estate deal are going to be deal sourcing and underwriting. So you got to find the deal and make sure the numbers work. Then there's going to be the due diligence and contract negotiation. So there's a little bit of back and forth. Once you figure out that the numbers make sense and you want to pursue, then you have to get a contract together and start going through due diligence to make sure that the numbers and everything line up. Property inspections, rent rolls, etc. Then you have to focus on the capital stack, which basically means how are you putting together the money that's going to take over this piece of real estate, whether it's land or whether it's an already existing apartment building. So that's going to mean investors or your own capital. It's going to be, I mean, we can get really complex into common equity, preferred equity, all that, but we won't. Just there's different ways to put the money together to get the deal done. Um, and then there's the value creation element. So you close on the deal. Now you actually have to force value. You got to create value. In terms of Josh and development, it means taking a piece of dirt and actually building something on it that has greater value than that dirt and has greater value than the cost to do the thing as well. Right. So that's the value creation. So through development or through improving a property, I do more value add real estate. I don't do as much development. So I typically buy properties that we think are undervalued. We improve them, right, through income, renovations, etc. And then we have some kind of equity event where we either sell it or pull money out of it. And then the last step is the ongoing asset management or construction management. So once that value creation has been had, there's ongoing management associated with it. Just like you can do a de novo startup in your practice, right? And build it up, and there's a heavy lift of value creation, but you still have to operate it once it's cruising. If you build that $2 million practice, you still have to manage it long term. So that's that management element. So those are kind of the five things.
Yeah, that's good. I'm going to take it from the developer sponsor perspective, which is very similar, just slightly different. I want to touch on that. So, when you're putting together a deal and you're not the only owner there, here's kind of the list that I go through. One is you got to find the deal, right? Whether that you're buying something or like buying a land to develop, and that takes time. I mean, a lot of time. People don't understand. Like when I say 200 properties I'm looking at 200 properties. Like it's constant. And some of them, it's a quick look, 10 seconds, right? But a lot of them, it's 5 minutes. A lot of them, it's a half an hour. A lot of them, it's 5 hours, right? You just kind of like filter it down the line. It's a huge time investment. So when people say, "Hey, I got this investment, do you want me to take a look?" For me to really take a look, it takes me 80 hours, all right, per
Yep.
investment. So I'm happy to give it the 1 minute, right? And if it's something that's like massive to somebody's life, like they're selling their dental practice or something, then I definitely spend the time with them to go in there. But if it's something like, hey, let's take a look at this investment opportunity, like I don't have 80 hours for the 200 ones that get sent to me, right? So you really have to be selective with sourcing your opportunities. So me, like Reed sources primarily around his property manager, right? Because it's like, hey, we have competitive advantages in this area that others don't, right? He'll look at other deals, he'll do other deals, but that's like primary. For me, it's the same thing. Like I know my local market, I have my local team, like I can do well here. I do other deals in other places, but it's got to be a really good partner that I really like for certain reasons. It's all about the partner, right? That's the most important thing is who that lead person is. Next, due diligence. So sourcing's first, and due diligence is really diving deep. Earnest money. If you got to lock up a property, you got to put money up front to lock it up, right? And then if you buy it, you got to put money up to buy it. And then you got to do all the architecture, the engineering. Like somebody's got to pay for all that, right? And if you're asking investors to pay for that, it's kind of hard. There's a lot of ambiguity around a property until you really get it to a certain point. So I don't ask investors for that. I front that capital, right? 500,000, a million, like 2 million. Like I'm fronting all that because I don't want to bring my friends, my family, my investors on that roller coaster. That is not their risk tolerance. They are not real estate developers, right? I need to have everything in a nice, beautiful Christmas package with a bow on it by the time I bring it to my investors. uh, Closing the transaction, right? Got to work with the title company, find the bank, find the financing. So capital stack, right? Equity we talked about, but also the bank. I mean, the bank's actually the biggest equity, the lender, right? They're the biggest, they're bringing most money to the table, right? That's a huge partner. You can't just like ignore that piece. Um, Guarantor who's guaranteeing the loan, right? You get best terms when somebody's putting their personal assets on the line. I typically do that because I want best returns for my investors. Raising capital, that's a whole nother job, right? That is a career in itself. And then investor management and communications, right? I mean, I'm fewer, deeper relationships, right? I don't want 1,000 investors. 99 is probably the number that comes to mind over time, right? Tops, like fewer, deeper relationships. CapEx management, right? You got to make smart decisions. What's going to have a good return on time, return on money, and day-to-day operations. And then with my developer hat, you're looking at market analysis and feasibility. Like, does it work? You're looking at land acquisition. You're looking at environmental. You're looking at surveys, site development, building plan, permitting, infrastructure improvements, construction financing. During construction, boots on the ground. I love that part. I love going out there and being on site. I miss it when I'm not out there. Project marketing, right? You got to market it to the community. You need tenants, whether it's commercial or residential. You got to work with your bank to, they say you can get the money, but during construction and remodels, you got to send them proof of what you've done so you can actually get the money. Just doesn't show up. Uh, you got to pre-lease, so you got to sell your project too before it's even finished, right? So you can pre-lease it, so get some of those tenant spots filled up on retail or get your apartment building filled up, right? Like as Reed is going in remodeling a building, he's trying to keep as many tenants as possible in there, but he's either rendering or taking pictures of one unit that look all pretty to try to rent out the rest before they're done, right? Um, and then once you get things stabilized, Reed was talking about he's got a pretty good loan on this next one, 6.2%. But once he gets it stabilized with Fannie Freddie or interest rates are coming down, Reed might be at 5.2%. He might be at 4%, right? Then you got to find that lender. And then you got to find the property manager. Most people don't have a great property manager relationship like Reed does, right? Those get developed over time. You got to find somebody who's not lazy, they're hungry, right? They're hungry but skilled. Once you're skilled over time, you grow, you tend to delegate, you tend to focus on lifestyle, right? So you got to find that sweet spot where somebody's still passionate, right? About doing their best. Um,
So if that sounded a little overwhelming, It's because it is, right?
It's
There's
another job.
it's a
It's
job.
just like dentistry.
It's a business. I mean, you have to like approach it like a business. It's not a hobby, right? Like you could potentially. I mean, if you want to be like a passive investor or maybe like do a couple flips here or there, it could be more of a hobby. But like when you're talking about big scale stuff, what we're talking about here, like the amount of time and energy spent on all of those steps, like just Josh kind of glossed over several things, but just the amount of time you have to work with your lender, right, just to secure that loan, the amount of compliance, the amount of documents you have to send them on an ongoing basis, like it's just a lot of stuff. Josh even mentioned he goes like when he was I want to go back to your development project just real quick, and when you're trying to figure out the vision of what you're going to put on that piece of dirt, right? And you're just like, okay, we're gonna do some townhomes. We're gonna do a little bit of multifamily that kind of hits the spectrum of low or affordable and market rate rent. You, I don't think people understand the complexity of the underwriting to figure out the math on all that because you're building multiple different products, which there's gonna have a lot of different inputs on that. But on top of that, you're all commanding different types of um, value in terms of like selling a townhome, right? Like a large equity sales versus like leasing something, renting it out. Like it creates a very complex financial model. And if you don't know what you're doing and you fail at that, you're in trouble. So
You're making me feel good, Reed. You know, like in life, you just look at all the places you haven't done yet on your to-do list, right? You're like, gosh, I suck. I haven't done these 5 items. Like, you're right. You're making me feel good. There's a lot to this. And a townhome isn't a townhome, right? Like the townhomes I'm building in my nicer area, in the $800,000 range are way different than the $600,000 townhomes that we're building, and way different than the $400,000 townhomes, right? A townhome is not a townhome, is not a townhome. We're building different products for different customers. And so, but it's not a problem. All this stuff is not over, it's a lot. So sometimes we both feel overwhelmed, but but I love it, right? Like I wouldn't be doing anything else. There's nothing else I'd rather be doing. And
mhm.
so when you're reflecting on this episode, I'm going to send a lot of people to this episode because this is a good one. Uh, when you're reflecting on this episode, like ask yourself, what do you want to do with your time? If listening to us gets you fired up about real estate, start reading books on real estate. If listening to this gets you overwhelmed, but you still want the yield, right? The higher returns in the stock market, like partner with somebody who understands real estate, right? So you can get the benefits and the investments, but you don't have to do it. So
it, so we should probably hit on that quick, right? It's just partnerships because that is the only other way to get this done and to start leveling up if you do not have these other elements, right? If you have capital but you don't have time and expertise, you have to partner with somebody. It just is the way it is. And what I try to do is partner with people that have the things that I don't, right? Or at least can do the things that I don't necessarily want to do, right? That's what we were talking about a little bit before. So as a simple example of Josh talking about deal sourcing, right? Trying to look at 200 deals to find one that works or whatever the difference, right? It's a big funnel down to one little deal that works, and this happens all the time. And even if you get them under contract, do the diligence, do the due diligence, you'll find that you don't want to move forward with that deal, and you're like, all that time wasted. Start over
all the
again.
time.
Start over again, right?
It
It's just
sucks.
it sucks. It sucks a lot, and you don't know when you're gonna. It's like fishing, but you're catching a fish like once a day, if that, right? Like way less than even that. So it's
I told you about that deal last year in the Tri-Cities, right? I wanted to buy that government deal. It was like a $50 million deal. We had like no competition. We were getting it at like, I don't even remember, like an 11 cap, right? Like long-term tenants, like the numbers on it were just astronomical, right? I went down there, I toured it, drove down there multiple times, like met all the stakeholders. Yeah, I was at least 80 hours in on that one. And then Elon Musk comes in. I'm a big fan of Elon, but he comes in and he starts like saying he's going to cut all these government employees, cut all these government leases. I'm like, oh man, like I got to
yep,
take a step back, right? There goes 80 hours of my time. It just, yeah, those are hard. Those ones where you go full length, like you're right up to the closing table and you got to say no, those ones hurt.
yes, yep. And
Um,
so And so what I know about myself, right, is that I don't like deal sourcing. I don't like talking to all the brokers to try to send me pocket listings. I mean, and I hate just like putting a deal quick into a spreadsheet, running it, going to the next one, running it. Like that to me, it feels it's not a waste of time, right? But it's not what I enjoy doing. And other people do it better and faster than I do. And so I partner with people that are really good at that. My partner Brandon is phenomenal. He's fast. He moves through spreadsheets like a wizard, right? That's not me. I'm clunky, right? I have to, okay, which this broke here. Okay, let me get, so can I do it? Yes. Am I proficient at it? Maybe, but I'm not great. I'm not the expert underwriter on these deals. Go ahead, Josh.
Yeah, if you're not passionate about it, you're never going to be truly proficient. You'll be able to get by, but you'll never be truly proficient.
It's drudgery if you don't like it, right? If you don't like it, it's some things you have to do, but if I don't have to, I'm not going to. So the point there is like I partner with Brandon because he'll present the underwriting to me, and then I'll start picking it apart based on my understanding of the market, the business plan, past properties, right? And so I want it all presented to me, and then I want to just poke holes in it and just try to stress test the deal until it falls apart. Like that's what I want to do, right? That's where I get incorporated into it. From there, then we get into due diligence, which again, I will complete due diligence, but there's certain tasks like verifying a rent roll that just is not fun. It's boring, it's data work, and I don't enjoy it, right? So I try not to do some of those things. And so when we're talking about doing these deals, whether it's the sourcing of the deal, the due diligence, the capital, the asset management, whatever it is, the value creation, I like I like poking holes in the deals, doing some of the due diligence, but mainly what I enjoy doing at that point is really analyzing the business plan and helping do the value creation. That's what I enjoy, the operations of it, and then the ongoing asset management. So it's also fun to work with the lenders, put the capital stack together. I enjoy that too, talking with investors, talking with lenders. So I don't mind that element, but I definitely don't enjoy deal sourcing and underwriting. And so I have partners, people that I partner with that are very good at it. And so, and in doing all these tasks, there's what we call sweat equity, right? If you are not just bringing all the capital to a deal, the people that are doing this work have to get paid in a certain way. And so we call that sweat equity, right? You are doing a task, you're putting time, your expertise in to be awarded a certain percentage of the pie, which is that piece of real estate or that deal. And so the way you do this, go ahead, Josh.
I just want to say I think this is such a great topic, and I think the content is just kind of coming out here for us. I do think we should wrap up and make
Break it
this a
up.
part one, part two,
Okay.
because this is absolute gold, and I don't want to abbreviate the next sections you're going to just because our time's getting short here. I think maybe wrap up equity and sweat equity, and then we'll just continue this. Maybe we'll continue this in an upcoming future episode because you're killing it, and I do not want to compress the good content, you're the great like wisdom that you're putting out. I do not want to compress that. I want you to be able to continue to expand. So
So
uh,
yeah, I can just wrap up this point. Yeah. So essentially what I'm getting at is if we know that these things have to get done, right? And you need time, capital, expertise to get them done, then essentially find the partners that can help you do those other things, right? That you don't necessarily want to do or you don't necessarily know how to do. And then you assign equity accordingly based on the amount of time or whatever it takes to do that thing. And there's rules of thumb, and Josh and I can maybe talk about those in the next episode. There's certain percentages and rules that we can talk about that might help you frame that. A lot of ways to do it, but I think that's just where I'll kind of wrap it up.
yeah, and I could go through my own how I break it down and when I choose to partner next week, next episode as well, because I'm very different than you. Although we seem very similar when we talk about things from an external, what Reed enjoys and what he's passionate and proficient about is actually very different than me. It's very contrary to me. And so I think us kind of fleshing those out would be super helpful for folks to realize too that you don't need to love all of real estate, right? You just need to be passionate about certain points and then partner with others. So okay. Well, that was a fantastic episode. As always, we covered the news, we covered some weekly updates and some pearls. We want to give you guys real stories with real pearls, right? Not vague, abstract concepts. And then we dove into some heavy, like real estate 101, hands off to hands on, investing across the real estate spectrum, so you can find your right place in real estate like we have. Thanks again, Reed.
Thanks, Josh.